Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from the New Zealand Herald on the 16th of November. Housing Minister Chris Bishop outlines government plans to make it easier for community housing providers to get finance. Topic number two from RBNZ Media Realease, 27th of November. OCR 4.25%. OCR lowered further as inflation returns to target. Topic number three from the New Zealand Herald on the 26th of November. Housing confidence rises as interest rates continue to fall. Fourth topic from RNZ on the 27th of November. The rule change that's likely to hit property investors harder. And topic number five from RNZ on the 27th of November. KiwiSaver provider suggests saving no less than $1 million for retirement. So first up for this week in review from the New Zealand Herald on the 16th of November, Housing Minister Chris Bishop outlines government plans to make it easier for community housing providers to get finance. The government's announced measures to support community housing providers, CHPs, in expanding their role in providing social housing. Housing Minister Chris Bishop aims to reduce the financial gap between Kāinga Ora, the state housing provider, and CHPs by addressing borrowing disparities. While Kāinga Ora benefits from low-cost borrowing backed by the Crown, CHPs face higher commercial rates, limiting their capacity to build social housing. Bishop criticised the previous Labour government's reliance on Kāinga Ora, emphasising that social and affordable houses must be built regardless of who constructs them. He proposed several initiatives to enhance CHP financing, including modifying government contracts to reduce risks for lenders, seeking Reserve Bank adjustments to lower capital requirements for bank loans to CHPs, and considering direct lending or financial guarantees from the Crown. These changes aim to make borrowing cheaper and less restrictive for CHPs. Labour's housing spokesperson Kieran McAnulty criticised the plan for lacking firm commitments to funding or building public housing. He highlighted Labour's record of delivering over 14,000 public homes during its tenure, contrasting it with National's prior reduction in public housing stock. In the coming months, the government will explore offering upfront subsidies to CHPs to improve their access to debt finance and develop leasing frameworks for new builds with private developers. It will also request a Treasury report on credit enhancement options by early next year, aiming to implement changes to stimulate CHP-led social housing initiatives. Currently, CHPs manage about 13,700 social homes across New Zealand, while over 21,000 individuals remain on the social housing waitlist. Topic number two from RBNZ Media Realease on the 27th of November. OCR 4.25%. OCR lowered further as inflation returns to target. The Monetary Policy Committee has reduced the official cash rate, the OCR, by 50 basis points to 4.25%, citing declining inflation and subdued economic activity. Consumer price inflation is now near the midpoint of the committee's 1 to 3% target band, with core inflation converging on the target. If economic conditions align with projections, further OCR reductions are anticipated early next year. Economic activity in New Zealand remains below potential, with weak demand for durable goods and falling activity in interest-sensitive sectors such as construction, manufacturing and retail. However, service sectors continue to grow. Excess productive capacity and reduced import prices have eased inflation pressures, with domestic pricing and wage-setting behaviours aligning with target inflation levels. Economic recovery is projected to begin in 2025, spurred by lower interest rates, though employment growth is expected to remain weak until mid-2025. Wage growth is slowing and unemployment is likely to rise in the short term due to subdued economic activity. Immigration's declined, with fewer arrivals and increased departures, partly due to labour market conditions. Globally, economic growth is expected to remain sluggish, particularly in the US, China and Europe. Persistent inflation in services and rising sovereign debt levels pose risks, including higher bond yields and inflation volatility. The OCR reduction has started to influence mortgage rates, which peaked at 6.4% and are expected to decline to 5.8% over the next year. While financial stress among households and businesses is increasing, the banking sector remains well capitalised and capable of supporting distressed customers. The committee noted that current inflation levels position them well to manage future volatility, despite medium-term risks such as geopolitical and climate-related factors. The decision to lower the OCR aligns with their mandate to maintain low and stable inflation while avoiding unnecessary economic disruptions. Further reductions are likely if conditions remain favourable. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor, and these events are available live, online, or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We've only got 2 free events left in 2024, so don't miss out. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. Topic number 3 from the New Zealand Herald on the 26th of November. Housing confidence rises as interest rates continue to fall. Housing confidence in New Zealand is on the rise, driven by declining mortgage rates and increased optimism about the property market, according to ASB's latest housing confidence survey. A net 24% of respondents now expect house prices to rise in the 3 months to October. That's up from 13% in the previous quarter, so quite a significant increase. Additionally, 20% believe it's a good time to buy, compared to 8% previously. Again, another significant increase in one quarter. Auckland stands out with a net 29% expecting house price increases, reflecting heightened optimism. However, ASB senior economist Kim Mundy noted that while sales activity is increasing, house price growth remains gradual. Approximately 72% of survey respondents anticipate stable or rising prices, down from 90% in early 2024, highlighting concerns over economic challenges like rising unemployment and slowing net migration. Nearly half of respondents, 48%, remain undecided on whether now is a good time to buy. The survey recorded a historic high in expectations for falling interest rates, with 57% anticipating further decreases. This aligns with forecasts of additional cuts to the OCR, the official cash rate, including a 50 basis point reduction expected, which happened last week, and further cuts anticipated in 2025. First home buyers and investors are becoming more active in the market. Nathan McGlarney of New Zealand Mortgages observed a resurgence in investor interest after years of inactivity due to high interest rates. He urged first home buyers to take advantage of the current market window before competition increases further. Recent data from CoreLogic revealed that first home buyers accounted for a record 28% of purchases in October, while multiple property owners made up 23%. Despite a 16% year-on-year increase in property sales activity for October, volumes remain 10 to 15% below typical seasonal levels, suggesting that the market has room for further recovery. Topic number 4 from RNZ on the 27th of November, the rule change that's likely to hit property investors harder. Debt-to-income rules, or DTI rules, are expected to impact property investors more significantly than first-home buyers, as falling interest rates bring these regulations into sharper focus over the next year. Introduced in July, DTIs were initially overshadowed by high interest rates and high test rates from the banks, but they're likely to play a bigger role as rates ease, according to CoreLogic economist Calvin Davidson. Under the new rules, banks can allocate only 20% of new lending to owner-occupiers with debt exceeding 6 times their household income, and to investors with debt above 7 times income. These ratios include other obligations such as student loans and credit card limits. So my opinion on that is that's 1 in 5 new loans to owner-occupiers and property investors that exceed their DTI restrictions. And at the moment, the percentage of loans above the DTIs is well below 5%. Davidson noted that investors often operate at higher DTI levels than first-home buyers, meaning that they're likely to feel the constraints more than first-home buyers. In 2020 and 2021, 40% of investor borrowing exceeded a DTI of 7, compared to 20 to 25% of first-home buyers exceeding a DTI of 6. Davidson explained that these rules would slow investors' ability to expand portfolios, particularly for those already managing multiple properties, as they'd need to grow their income before taking on more debt. He emphasised the rules' role in ensuring financial stability rather than directly targeting housing affordability. While DTIs may not lower house prices outright, they could help maintain more sustainable price levels compared to past cycles where falling interest rates fueled larger loans and higher prices. New builds are exempt from these restrictions, and the latest data indicates only 2% of first-home buyer borrowing and 3% of investor borrowing currently exceed the DTI caps. Elevated bank test rates and cautious borrowing behaviour due to job market concerns are also limiting high DTI loans, Davidson noted. New Zealand Property Investors Federation spokesperson Matt Ball suggested DTIs would become more impactful if the housing market strengthens as expected. In high-price regions like Auckland, banks hitting DTI limits could restrict lending across buyer categories. Serena Gibbon, General Manager of the Auckland Property Investors Association, described DTIs as a proactive measure to prevent unsustainable property price increases in future cycles. She argued that the framework fosters a balanced market by giving first-home buyers a better opportunity to enter, which is crucial for the long-term health of the New Zealand's property sector. Squirrel Mortgage Advisors added that lower-income households might feel the effects of DTIs more acutely due to higher levels of consumer debt, such as car loans and credit cards. The rules are also likely to affect high-income borrowers with unverifiable income or large credit card limits. Topic number 5 from RNZ on the 27th of November, KiwiSaver providers suggest saving no less than $1 million for retirement. A comfortable retirement in New Zealand may require at least $1 million in savings, according to KiwiSaver provider Cora Wealth. Founder Rupert Carleon emphasised that retirement savings depend on lifestyle goals, but are likely to reach 7 figures. He highlighted that retirees typically spend more during the first decade on leisure and the last decade on healthcare. Carleon cited research suggesting retirees need 70 to 100% of their pre-retirement income. For example, someone earning $120,000 annually would need $1.1 million for a 70% income replacement or $1.8 million for a 100% replacement, even factoring in New Zealand superannuation. New Zealand Super provides $519 weekly for singles and $400 each for couples. Actuaries recommend withdrawing 4% annually from retirement funds, meaning an additional $1.5 million is necessary to generate $60,000 annually above the pension. A 2022 Massey University study estimated a single person in a metropolitan area requires $717,000 for a comfortable retirement, while a couple needs nearly $1 million. This study is due to be updated any second now, so it'll be good to see those results come out. Costs are similar in rural areas where singles need approximately $824,000 and couples $609,000. Retirement Commissioner Jane Wrightson stressed that longer lifespans, averaging 90 years for men and 94 for women, demand savings to last 25 to 30 years. She advised planning for higher expenses in early retirement before reducing costs later. Tools like the Sorted Retirement Calculator can help. Financial coach Liz Coe recommended saving 30 to 50% of a home's value. For instance, homeowners with a $1 million property should aim for $300,000 to $500,000 in retirement savings. She noted cities are costlier to retire in, but reassured that few people achieve $1 million in savings. Young savers starting KiwiSaver at age 18 on a $50,000 salary could accumulate about $340,000 by age 65 in a growth fund, assuming no first home withdrawal. Achieving $500,000 would require saving 6% of income or faster than average salary growth. My thoughts on this, obviously it depends on how much debt you've got going into retirement. I mean, if you're mortgage free, you're probably not going to need as much savings coming in, to help top up your retirement versus someone who has still got a substantial mortgage that they're paying on their home. A lot of people also downsize their home because the home is quite often the largest asset. But there's certainly lots of things that you can do around your KiwiSaver. Talk to a financial advisor and get advice around your KiwiSaver sooner rather than later. Don't let yet another year pass without taking control of your financial future. Learn the ins and outs of property investing and set yourself up for success in 2025. Register now for one of our free events called How to Succeed with Property Investing. These events are available online and in person. Whether you're a seasoned investor or just starting out, our free sessions will provide you with the essential tools and insights to make smarter, more informed decisions. Don't miss this opportunity to stay ahead of the curve and take the next step towards achieving your financial goals. For clients of ours at Property Apprentice, I offer KiwiSaver advice as part of the package at no extra charge. In our free events, I'll also tell you about how else we help our clients to achieve their long-term investing goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today and sign up for one of our free events. If you've already been to one of our events and you'd like to know more about how we can help you, get online and book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. It's propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.